Bill Hornbarger, Chief Investment Officer with Benjamin F with a few thoughts on the June FOMC meeting and decision. Well, the Fed did as expected and raised the target Fed funds rate 75 basis points, and that puts it currently at 1.5 to 1.75%. That's after starting the year at 0 to 25 basis points. So some significant movement in terms of the overnight rate, target Fed funds rate. The Fed also said that they will stay on course in terms of the reduction of the size of the Fed's balance sheet. Remember, they've bought billions of dollars in bonds over the last decade in quantitative easing, and have decided to reverse that policy and very gradually reduce the size of the Fed's balance sheet. So no changes to that news. Fed Chairman Jerome Powell had a press conference immediately following the rate announcement, and the first thing that he said, the first statement that he made, was that the Fed is committed, and he used the term committed, to fighting inflation, bringing it back down to acceptable levels, and that the Fed has the policy tools to do so. So I think that was a very firm acknowledgement that the Fed realizes that fighting inflation right now is kind of the number one concern. At the same time, as we had the meeting, the Fed also released updated projection materials, and they do this a couple of times a year, where the Fed members give their economic forecasts and forecasts on things like GDP, the unemployment rate, Fed funds rate, inflation, and things like that. And then they create kind of a consensus view from that. So a couple of things jumped out from that. The first one is that the Fed, in the projection materials, acknowledged we're probably not going to get a lot of relief on inflation this year. They show inflation staying well above kind of their stated target of 2%. Significantly above that in calendar year 2022, but they do showing it drop noticeably in calendar 2023 and getting back very close to that target 2% range. The Fed also forecasts that the unemployment rate is going to stay relatively low as we work through this cycle. Did tick up a little bit, but not significantly, and that it will stay centered around 4%, maybe slightly under that the next couple of years. And then the long-term kind of trend in that number would be 4%. So if you look at those numbers in aggregate and some of the other things, it would tell you that the Fed seems that they are forecasting a soft landing, and that's obviously the goal here. The Fed wants to raise rates relatively aggressively to fight inflation, but doesn't want to tip the economy into recession. Only time will tell if they're going to be correct in that assessment or not. I think the other thing that really stood out is kind of forward projections on monetary policy. The last projection materials had the Fed funds rate peaking at 1.9% at the end of calendar year 2022. That was significantly increased. The Fed consensus is now 3.4% for kind of the year-end target for the Fed funds rate. If you do the math, 4 meetings left, that probably means 4 additional increases of 50 basis points each if the Fed is correct in their assessment. Fed Chairman Jerome Powell also made early in his comments that 50 to 75 basis point increments are on the table for the next several Fed meetings. So again, the Fed very aggressively looking at inflation. And then they show in 2023 the Fed funds rate peaking for this cycle at 3.8%. So again, if those projections are correct, the Fed's saying that they have a lot of work to do. The market's reaction in the immediate aftermath of the meeting was positive. Both stocks and bonds rallied. Stocks wobbled a little bit as people digested the comments, but last I checked, the Dow was up almost 400 points. S&P and NASDAQ also up. So again, I think the market got what it wanted to see. It got the expected outcome. 75 basis points, but more importantly, the rhetoric from the Fed that says we realize we have a problem and we're committed to fighting it.